For years, one idea has dominated the luxury watch world. A Rolex isn't just a watch, it's protection, a hard asset, a store of value, something that holds steady when everything else falls apart. That belief went into overdrive after 2020. During the pandemic boom, prices for stainless steel sports models, especially pieces like the Daytona and the green bezel Submariner, didn't just rise. They exploded. Some tripled on the secondary market. Social media turned watches into investments. Waiting lists became status symbols, and the narrative hardened. Rolex was recession-proof, but markets don't move in straight lines forever. Over the past 9 quarters, the secondary market has undergone one of the sharpest corrections in modern watch history. Certain flagship models are down 30 to 40% from their 2022 highs. What some once called a permanent shift now looks a lot more like a cycle. So the real question is this: how can something marketed as a financial safe harbor experience a drawdown of that size? The answer requires separating the watch itself from the hype wrapped around it. A Rolex didn't suddenly lose its engineering quality. What disappeared was the speculative premium layered on top of it. To understand that, you need to understand how the Rolex ecosystem actually works. The Rolex market is not a traditional retail system. It operates more like a controlled distribution network designed to create structural scarcity. Official retail pricing and real-world market pricing are intentionally disconnected. That disconnect is not an accident. It's central to the brand's strategy. Rolex produces roughly 1 million watches per year, yet demand for specific stainless steel models consistently outstrips supply. This imbalance isn't purely operational. Controlling output protects brand positioning. Limited availability reinforces desirability. When something is hard to obtain, perception of value rises. Authorized dealers sit at the center of that funnel. They receive limited allocations of the most sought-after references: Submariners, Daytonas, GMT Masters, often in very small quantities. These pieces rarely make it to display cases. Instead of traditional waiting lists, many dealers operate informal interest lists, where allocation is influenced by purchase history and relationship strength. That structure gave rise to bundling, customers buying higher-margin jewelry or less popular models to increase their chances of being offered a steel sports watch at retail. In practice, this meant the retail price wasn't always the true entry cost. It was just one piece of it. When supply is artificially constrained, a secondary market fills the gap. That's where the gray market comes in. It isn't illegal. It's simply the free market responding to limited official distribution. Flippers with access to retail inventory sell immediately at a premium. Buyers pay extra to skip the wait. That premium is critical. It represents the price of instant gratification. It's not steel. It's not craftsmanship. It's sentiment. And sentiment is volatile. During the 2020 to 2022 period, extraordinary conditions fueled that sentiment. Ultra-low interest rates, stimulus spending, crypto wealth, and speculative capital all converged at once. Luxury watches became tradable assets. Prices detached from fundamentals. Some models traded at 2, 3, even 4 times retail. That environment was unusual. When central banks tightened policy, speculative assets retraced. Crypto collapsed. Liquidity dried up. And the watch market followed. Indexes tracking secondary prices show broad declines of over 30% from peak levels. For buyers who entered at the top, the correction was painful. History reinforces this pattern. In the early 1990s recession, luxury goods softened as consumers sold assets to raise cash. During the 2001 tech crash, some high-net-worth individuals rotated into tangible assets, helping support the early narrative of watches as stores of value. But the 2008 financial crisis revealed something important. Retail prices may remain stable, yet secondary markets can stall completely. Retail pricing rarely drops. That protects the brand image. But the secondary premium, the part above retail, can evaporate quickly when confidence fades. That leads to several hard truths. First, When you pay above retail, you are not investing in a watch. You are buying the watch and separately speculating on the persistence of the premium. If that premium compresses, the loss has nothing to do with the quality of the product. It's a repricing of sentiment. Second, modern demand has shifted. A meaningful segment of buyers in recent years approached watches through a speculative lens. When outside asset markets weaken, that demand can recede just as fast as it arrived. Third, liquidity changes in downturns. In strong markets, desirable watches sell quickly. In recessions, forced sellers increase supply, while buyer pools shrink. That creates downward pressure. Assets that feel liquid in bull markets can become slow to move when conditions tighten. Fourth, a Rolex is not gold. Gold historically benefits from fear and systemic uncertainty. Rolex demand thrives on prosperity and aspirational spending. One responds to panic by rising. The other depends on confidence. None of this means a Rolex lacks value. It means the value must be framed correctly. Buy it for the design, the engineering, the heritage, and the enjoyment of ownership. If appreciation occurs over time, treat it as a bonus, not a guarantee. The idea that any luxury good automatically shields you from economic cycles is a myth. Retail prices may trend upward over decades. Secondary premiums, however, move with sentiment, and sentiment can reverse quickly. So here's the real question. Is the gray market premium simply the cost of skipping the line, a convenience fee fueled by emotion? Or does it reveal deeper, structural imbalances in how the system operates? Let me know what you think.